So we've got a good chunk of people joining us here. And so we're excited to put on this first Balanced Wealth webinar here. So thank you all for coming and thank you all for being patient as we rescheduled from last week. Nick, thankfully, didn't get swept away by any storm or anything like that. He's here with us. But we talked a lot about things we want to do at Balance to just communicate with all of you and fill you in on what we're thinking. And these webinars are something that we plan to kind of start this with today, but continue to do in the future. Our next one is going to be a Roth conversion seminar, which we'll try to do in kind of October timeframe, which lines right up with tax planning at the end of the year. But we thought it would great to be kick off with the tax loss harvesting and direct indexing webinar. As one, we're putting a lot of these in place for clients currently and have been over the years. So just kind of filling in what has been happening and then introducing what is called direct indexing, just to talk a little bit more about it, what it is and how it can benefit you. So we've got Nick Gookin here, who's going to take it over, our Chief Investment Officer here at Balance, and let him go through what direct indexing is, how it works, what tax loss harvesting is, how it works, but also some places that it can make sense and some questions and considerations as it comes to that. So with the questions, we absolutely encourage questions throughout this presentation. If something makes sense, or there should be an opportunity for you to put in questions right on the chat within the Zoom. If a question comes through and it makes sense and it's relevant, I'll interrupt Nick and say, hey, Nick, we got a question from, so-and-so, and here's the question. Can you, as it relates to this? Otherwise, we'll wait until the end of the session where we'll do a question and answer just to kind of follow up and fill in some gaps from the presentation. So please feel free to pop questions in there, but without further ado, I'll let Nick take it over and go from here.
Cool. Awesome. Thanks, Bob, for the intro. And yeah, thank you all for joining us tonight. It should be a fun time. Not a lot of people tune in to their Tuesday nights to learn about taxes and, tax efficient investing. But this is actually an area that I have a lot of experience in. And I'm all excited about it. I'm giddy about the subject. So hopefully y'all will be excited about it too by the end. So, all right. So the main thing that we're trying to accomplish here is just make sure that we maximize the amount that's in your pocket at the end of the day and minimize the amount that's in Uncle Sam's pocket. And kind of thinking about your after-tax wealth is one of the things that's kind of hard to quantify usually, but it's one of the things that's the most meaningful and impactful things in your financial plan. So on that note, just wanted to give kind of a touch on some subjects and see, like, is this webinar really right for you? And let's see here. So if it's right for you, step one, do you have investment accounts that are not IRAs? So meaning like 401ks or IRAs or Roth IRAs. All of those things are great, but this webinar is for folks that have other accounts like individual accounts or joint accounts or trust accounts where they're taxable or every single trade and transaction is taxed at the time of the transaction. So that's a big one. And then secondly is you're interested in maximizing your after-tax wealth. If that's you, then you're in the right spot here. And also, like, this is something that you'll have to come to the conclusion of by the end of it, but hopefully you'll be okay with adding some complexity to your financial plan or your life or just the amount of documents you get with the trade-off of more tax efficiency in your investment accounts. And we'll help you weigh the pros and cons there. And then lastly, maybe this webinar was just really close to bedtime and you knew that taxes would be the perfect nightcap. So if that's you, glad you're here and we're excited to go through this regardless. So, all right. So on the topic of just like holistic financial planning, these are just some of the different building blocks or tools in the toolbox that we have to help clients make the best of their situation. And tax loss harvesting and direct indexing kind of pair those together. But in my humble opinion, I think that's, the base of the financial planning pyramid here. Not that Roth conversions and any of these other things are important, because they certainly are. But in my opinion, tax loss harvesting, the trading guy, it's like, yeah, the trading stuff's the most important. So yeah, this is a big piece of everyone's financial plan, whether they realize it or not. And it's one of the things that, again, I have a lot of experience helping clients with. So ultimately, what we're trying to do is turn your losses into wins. We know, and if you've ever invested in stocks before, you know that it's never really a straight line experience. There's almost always some bumps in the road. And our job, or what we aim to do, is to make the most out of those bumps. And there's actually a lot of different things that we can do to add value for you when there is market volatility, because it's not really an if, it's a when. And we just want to make sure that we are set up with the right strategies in place to take advantage of that. And on that same note, though, as we take advantage of the market volatility, there's a lot of different things that we can do with the losses that we create. And one of them is easing out of concentrated positions. So legacy stocks or highly appreciated stocks elsewhere. And if you don't have anything like that, it's still beneficial to you. We can actually carry forward losses into future tax years indefinitely, which is a great plus here. So some of the goals of what we're trying to achieve ultimately is just to put the steering wheel of taxes in your hands, or in your financial advisor's hands, our hands. So that way we control when and how we realize capital gains. And it's one of the things that like sounds so intuitive. It's like, yeah, obviously I want to control how my taxes are coming at me. But historically in this industry, they're not really operated that way. The investment vehicles that were originally created didn't give you the control to control how taxes are realized. So on that note, what we're trying to aspire here is creating tax assets. So when we create a capital loss, and we'll go into all this deeper here, so hang with me. But when we create a tax asset, we can use that to offset something else in the portfolio that has a gain. So if you have Apple stock with a big gain, and we have a capital loss elsewhere in the portfolio, we can chip away a corresponding amount of Apple stock to neutralize the tax burden while creating diversification. But also what's really cool is that tax asset can be used in things not in the portfolio. So maybe you sold a business, or you're selling a investment property and you have a big capital gain. The tax loss harvesting, or those capital losses, can actually be used to offset those other things elsewhere in your life, which is great. And then this third point here, creating a tax asset which can be used to lower taxable income. It's only $3,000 of taxable income, but it can still be a meaningful amount, $3,000 to $3,000. And it's something that we can do. Let's say that you had a $10,000 capital loss. Well, then you could offset $3,000 of income for 3 years. So it's not something that we want to overlook or understate the importance of, but that's another cool thing there. And then ultimately just allowing us to delay realizing gains until it makes the most sense to do so. So we'll go into some of these here more. But before we do that, I want to take a minute to pick on mutual funds. So these are some different investment vehicles. You've probably heard of stocks and bonds before, like, Apple, Coca-Cola, or buying bonds in either of those companies. Exchange traded funds. If you're a client of ours, you're intimately familiar with these already. These are ETFs, and they're essentially a basket of individual stocks or individual bonds that allow us to pretty tax efficiently trade in and out of those things. Mutual funds are kind of the predecessor to exchange traded funds. And they're just generally a lot clunkier of a vehicle to get from point A to point B. And as we focus in on mutual funds here, this slide, I think, does a great job illustrating why mutual funds are suboptimal in taxable accounts. So the blue bars, I know there's a lot going on here. So the blue bars is the stock market, right? So we can see the ups and the downs and all that. But the red line is the average capital gain distribution of mutual funds that year. So you can see even in years like 2008, when the market is down big, mutual funds still pushed capital gains onto its shareholders, meaning that the shareholders then had to pay taxes for capital appreciation in a year when their portfolio value was down huge. And so on top of your portfolio being down, now you also have a tax bill at the worst possible time. And that is not what we want for any of our clients. And it's something that we certainly try to avoid. And 2008 was a big example, but they haven't gotten any better or more efficient. You can see the same thing happened in 2022. Markets were down about 20% through that calendar year. The average mutual fund had a 7% capital gain distribution. So I know I've said the word capital gain distribution like 3 times in a row here, so we're going to talk about that. What does that even mean? So I love this chart. It's our Pac-Man chart. You'll see why by the end. So let's say that you have $100,000 in a mutual fund, and that mutual fund declares a 10% capital gain distribution. So that means that 10% of your position is being distributed to you as a line item in your account, and it'll say capital gain distribution. And so it's a cash flow out of the fund. So your position actually kind of drops down for a second. But then even if you reinvest that $10,000 back into the fund, so it's still a $100,000 pie, what happens is that $10,000 is taxed, and it gets taxed at whatever your tax rates are. So in this scenario, it's assuming a 24% overall tax. So it's a 2.4% of the overall wealth gets eroded by this capital gain distribution. And that is something that, quite frankly, is really, it happens all the time and it's avoidable. So it's one of the things that makes this whole idea of tax efficient investing really compelling, because the vehicles of yesterday net hurt clients over the long run. And even if you recently purchased the investment, this is a real kicker, especially as we get closer to the end of the year. And I see this all the time, quite frankly, but it's if you invested in a fund in like November, and so you weren't invested in it for 11 months of the year, and you buy into it in November, well, they do this capital gain distribution calculation annually, typically at like end of November or even December. And so what happens is you could have this capital gain forced upon you, even if you were a shareholder for 1 day and you didn't actually participate in any of the accrued growth of the fund, but now you're participating in the accrued tax impact of the fund. So that distribution declaration date sounds very official. It's something that we certainly watch out for. And unfortunately, it's not like weighted based on how long you were in the fund. So even if you bought it recently, you can still have this on you. All right, now you see why this chart is the Pac-Man chart too. Okay, so enough picking on mutual funds. What is this tax loss harvesting that we talk about all the time here? So when you buy a stock, you typically, there's only 3 things that are going to happen. It's either going to go up, sideways, or down. So in this scenario here, we're going to talk about what happens when the stock goes down. And scenario 1 is we don't do anything. Maybe it dips down and then dips back up to where it was. It's like, okay, well, that's great. You're back to where you started. You didn't lose any money. But there was an opportunity that we missed there. So tax loss harvesting is when this dip happens, you swap into a different investment that hopefully has the same exposure of what you're originally invested in. So you're not trying to like change your portfolio, trying to keep the exposures the same. So when it goes down, you sell it and you harvest a loss, put that in the bank. And then when the market recovers, now you are okay owning that new security into the future because it has the exposures that you want. And the benefit of going through this exercise is that now you have a capital loss in the bank that you can use for all those things that we talked about at the beginning of the presentation. So this slide, it's a little bit granular and into the weeds, but it's showing 2 scenarios, a portfolio without TLH, tax loss harvesting. We love our acronyms, I know. And it's showing how if you do nothing, $30,000 at the end of the first year, markets are down 10%. So now you have $27,000 and you do nothing and you just wait. And then markets rally, big rally here, 100% gain. And now it's worth $54,000. And so then when it comes time to liquidate it, you're paying, in this case, a 20% long-term capital gains rate on that investment. So 20% times your $24,000 capital gain, net of that, you have $49,000 in the bank. Still good, right? Like markets went up, did all right. But there's another option that we have here, and that's tax loss harvesting throughout this whole experience. And when markets drop initially in that first year, drop by 3,000, if we harvest that $3,000 loss, aka meaning that we sell it, well, now all of a sudden we have, and we're going to assume that in this case it's a 30% short-term capital gain. So it's going to assume that that put $900 in your bank. 30% times $3,900. So now you have $27,900 here, because in this scenario, it's saying, hey, what if we invested that tax savings in that moment? And so then when markets rally, you have more money invested because you did this loss harvesting opportunity and you offset income in your life. And so then you had more to invest. And then when it comes time to actually liquidate, you end up with more, in this case, $1,000 more overall. And that's a combination of having more money invested because you paid less in taxes, but also it's talking about a tax rate substitution. So basically you traded, you offset your income that was at a 30% income rate, and you traded that by paying taxes at the 20% rate in the future. And that's because income and short-term gains are taxed at typically at a higher rate, oftentimes at twice as high as rate as what capital gains are taxed at. So it's a combination of all those things. It's net beneficial. So that was kind of an example, but what about some real world studies? Is the juice of going through these gymnastics really worth the squeeze? And based on multiple research studies, I just named a few here. This is the average annual benefit of a portfolio value over time. So Morningstar saying from 0.5% to 2% plus, and net. I love Altruist. If you all are at Altruist, you know how simplified they are. They're like, yeah, it's 1 to 2%. And I actually ran one of these studies a few years ago. And my results were kind of similar to the Morningstar scenario, where even people in the lowest tax brackets still saw almost, 0.5% of benefit. And then clients in the higher tax brackets saw over 2% of added portfolio value every year. So this is something like, is going through all this worth the squeeze? In our opinion, the answer is yes. But again, it doesn't come without its trade-offs. And the main trade-off is just a little bit more complexity, but we'll get to that here. So anyway, tax loss harvesting, back to this slide here. We talked about what happens when stocks go down, right? But now let's say your stock just went sideways or up. Well, now what happens? Is this whole thing we talked about, invalid or doesn't make sense for you anymore? Well, let's see. That's where direct indexing enters the conversation. And this is a really cool concept. It's taking all those things that we just talked about in tax loss harvesting and then just magnifying it. So first of all, we're talking about direct indexing. What is an index? So an index is a pool or a basket of stocks that represents a specific area of a stock market. So the most common index that y'all are probably familiar with is S&P 500 or the Dow Jones. And again, those are just baskets of stocks, and they kind of track, these ones in particular, people like to use them to track the overall health of the US stock market. So now that we know that, let me just give you an example here. So in 2023, this is a SPY, which is an ETF that tracks the S&P 500. So over the course of 2023, it was up like 26%. All right. But really, the S&P 500 is a basket of the 500 largest stocks in the stock market. So really, this is an average. It's S&P 500. You can think of it just as a dollar-weighted average of that basket of 500 stocks. So visually, what does that look like? Well, I didn't throw all 500 lines up here, but there's a lot of lines up here. And it's just showing like there's some stocks that are up a few %. There's some stocks that are negative over that time frame. And then the blue in the middle is that S&P 500 experience. So as you can see, results will certainly vary. And there's the 500 stocks, each of those are going to move differently and oftentimes not all the same together. Like they typically don't all trade up together or all trade down together. There's usually dispersion in the index. So this chart also shows kind of the same thing, illustrating the same concept, a little bit different. But again, focusing on 2023, all these blue lines were stocks that were positive. So you can see there was a bunch that were positive, but also there was 171 names that were negative on the year. So even though the stock market was up 26%, there was 171 US large cap stocks that were negative for the year, which is crazy. But what's even more crazy is that 3/4 of the stocks had a drawdown of more than 15% at some point during the year. So 3/4 is like, I don't know, something like this. Let me see, like all of these, hypothetically, 3/4 of those had volatility downwards of a big extent, not a little bit, like 15% over the course of the year. And so that's why it's super important to look at this not only annually, not once a year, but as time goes on throughout the year, month to month, and even day to day. So again, direct indexing, even though the market goes up or the market goes sideways, that's where direct indexing gets really useful and helpful, because there's still tons of loss harvesting opportunities, even in those years when the market rips higher. There's a lot of opportunity there. And it's even magnified when the market is flat or down. Okay. I'm gonna keep going here. No questions yet, Bob? We good? Let's see. Okay, cool.
Yep.
So what are the core drivers of this tax loss harvesting benefit? And this is a great chart that Vanguard put together, and it's showing like on the left-hand side, there's less tax loss harvesting potential, and on the right-hand side, there's more potential. So what we're talking about with direct indexing is when you have 500, you're actually going into the account, we're buying 500 stocks in your account instead of buying the one ETF, because the reason for that is this portfolio construction. If you just have a few broad-based funds, well, then eventually like you'll run out of opportunities to tax loss harvest, or there's just not that much dispersion in the index. So when you buy all of those stocks, then you have tons of opportunities for loss harvesting potential. And then also when volatility is higher, obviously there's more harvesting potential. I know many of y'all have been with us through the last 5 years, which have been plenty volatile for anyone. And if you've been a client of ours, this tax loss harvesting is something that we've already been doing in your accounts. And so as markets have been like through COVID and through 2022, of all that market volatility, we were taking advantage of that and doing this tax loss harvesting stuff. And so y'all may or may not have known this is what's going on or why there have been so many trades in your accounts, but this is a big piece here. So I'm gonna keep going now. All right, so we talked about tax loss harvesting, not only just once a year at the end of the year, but actually month to month. And this chart's doing a really cool job at showing the blue bars are all the stocks that had a negative monthly return. And again, this is still looking at 2023. So you can see just like visually throughout the year, there was tons of opportunity month to month to do this loss harvesting. And in addition to that, looking into 2024, it's been largely the same story. Even though markets have been ripping higher, there's been hundreds of opportunities to do this loss harvesting throughout the accounts. So even though it's been strong markets, the opportunities are there. not only at the end of the year, but there's a lot of value to having a hands on the wheel and us being hands on the wheel for you throughout the year, not just once a year. Okay. All right. So this scale is awesome. It shows kind of going back to those different investment vehicles as far as what's the least tax efficient thing you can do and the most tax efficient thing that you can do. So actively managed mutual funds, they're on the not good scale. And there's a study done by BlackRock recently that showed owning an actively managed mutual fund in a taxable account has historically caused about -2% of performance on the fund. So that fund's got to be really performing well to outperform its benchmark, outperform the markets, and outperform the tax hurdle. So typically, like, there's ways that we can get exposure to the things inside those mutual funds without having to go through that antiquated wrapper. But even what's kind of surprising as I was going through this, just buying and holding ETFs, which are really tax efficient, like that will still cause a net negative impact on your life because A, there's income coming off those ETFs, but then B, most of our clients are not 100% in stocks or 100% in bonds. So when it comes time to rebalance, or like when stocks go up higher, then it's time to reset the portfolio back to where we want it. That will cause a taxable event. So even just a very static allocation of tax efficient ETFs, like not bad, but it'll actually cause a net negative tax experience for you. So what most of our clients have experienced, again, has been this ETFs with tax loss harvesting. So we did this for y'all. I've been using the software that helps us do this for the last 7 years, so I'm really familiar with it. But this, again, it's pretty good. Like most of our clients have seen at least 0.5% to a full percentage, and in many cases, even more than that, of benefit with this tax loss harvesting using ETFs. But now, largely thanks to the advent of technology, direct indexing is becoming more and more accessible to everyday folks. And many of our clients, where before you would need like a huge account minimum and it'd be expensive, like there'd be fees or commissions even and transaction fees. It wasn't even that long ago that there was trading fees to buy and sell stocks, and that gets really expensive when we're talking about 500 stocks. So now that those trading fees have largely gone away and technology has gotten better, direct indexing is now within reach and makes sense for a lot of people. And it typically, as we kind of stealing the altruist number here, will provide a plus 1% to 2% of performance benefit versus just not doing that. So as I keep going here, the trade-off is owning a single fund or like a single mutual fund is probably the most simple thing that you can do because there's only one line item on your statement. It's real easy to keep track of. Your tax form only has like one thing on it. But just because it's simple in this case comes at the trade-off of not good tax experience versus in the case of direct indexing, where it will look and feel more complex because there'll be a lot more line items and more things going on in the account. It's still simple because the technology allows us to do this at scale and keep good control and in place of everything, but it's less simple for the client experience, right? Like when y'all look at your account and you see 500 stocks in there versus just a few. So there's pros and cons, and that experience is probably the single biggest con, and to some people that might be overwhelming, but in many cases, if you're willing to have those line items, it can certainly pay off. So I'm gonna keep going here. Now I'm gonna pick on these two just because I have a little case study here that compared direct indexing and the buy and hold ETFs. And so this was a study done by Smartleaf, which is another provider who does all this tax loss harvesting stuff. But essentially, they found that direct indexes are 3 to 5 times more tax efficient than ETFs. And that's even exponentially more tax efficient than mutual funds. But these are both two great things to compare. And they found that the 3 times more tax efficient was when markets are going up, and they were actually 5 times more tax efficient as markets were going down. So it's a big deal to pay attention to these things and make sure we're using the right tool and the right account at the right time. So considerations. So consideration number 1 is this works out best, or it can work out. You'll maximize the loss harvesting if we're talking about getting cash invested or something like that. Like if you have cash on the sidelines that, we're not going to cause a giant capital gain to invest into direct indexing, that's where this can become really helpful. And if you're worried like, oh, I don't want to invest and then the market go down, it's like, well, guess what? If the market goes down, we're going to squeeze some juice out of that situation and make some benefit there. So next question that we often get or consideration is, what if, half my account is fixed income or bonds? Well, this whole concept of tax loss harvesting applies also to fixed income. So you can do the same thing within fixed income, and we did do the same thing within fixed income, especially over 2022 when bonds saw double-digit volatility, which is certainly not normal. But that tax benefit that came from the bonds was way more beneficial than owning the bonds were throughout that time period. But it's still a great consideration and something that we still do. And then carry forward losses. So do you have any losses from outside of your other things going on in your life? Or on the flip side, do you have any more like expensive tax bills coming up? You're like, hey, I'm going to sell this business or this property, and it's going to create a tax bill. What are some ways that we can plan around that? That's where these get really, really interesting, and the benefits really start to stack up. So, all right, I think I just talked for a good amount of time here. I'm going to keep going. Any questions?
Yeah, so I saw one question come in, Nick, and just generally with direct indexing. So if we own these 500 so stocks, is there a ballpark for how many trades you maybe can expect over the course of the year, or does it vary? Like what's kind of the expectation that somebody could have from doing direct indexing versus just owning an ETF?
Yeah, certainly way more transactions. I think the slides that show all of the different loss harvesting opportunities, let's see here, and pull it back up. In a month-to-month format, it was right. Anyway, I would say a lot. And not that that's a bad thing, right? Like we talked about, here it is. There you go. So hypothetically speaking, going back to 2023, just as an example, each of these would be harvestable opportunities. So you might see 100 trades in January, 300 trades in February, 200 trades in March. It'd be a lot of trades, right? So it's, and again, it's something that is really hard. Like technically you could do this yourself, but having technology to help us automate a lot of this and to leverage our skills and our tech is certainly the better way to do it. But yeah, I would say the expectation would be hundreds of trades throughout the year and even month to month, even in 2024. So, okay.
Got another question about wash sale rules. Can you talk about what that is and what that means?
Yeah, absolutely. So great question. First of all, wash sales are the actual technical definition from the IRS is a wash sale occurs when you buy or sell a security at a loss, and within 30 days before or after, you buy back into that same security or one that is quote unquote substantially identical. So essentially they're saying you can't sell Apple on Monday and book a loss and then buy it again the same day or the next day. You'd have to wait 30 days to buy that one stock back. But this whole substantially identical thing that's in bold is one of the things that the IRS has purposely never given clarity on. They just threw out these words substantially identical and then never clarified what that means. And so so it's something that we certainly keep in mind. It's something that's built into the processes of how we do trading and investing. But it's something that we look at for sure. And we have a whole process built in place to determine what is the right thing to rotate into when we do book a loss. So. Okay.
And then we got another one. Are you currently utilizing these strategies in our investment portfolio?
Yeah, so I'd have to make sure that I know who I'm talking to and know what I'm looking at, but chances are if you have a taxable account with us, we were already employing tax loss harvesting using ETFs and funds. Direct indexing is a newer thing, especially with altruists, because we can do fractional share trading. So it becomes a lot more accessible, lower minimums and all of that. And so we do have some clients that are already using direct indexing, but it's just kind of a newer thing that, again, just the advent of technology is kind of pushing us in this way where it allows us to play this game on your behalf. So chances are we are using it, at least the tax loss harvesting part, and probably not direct indexing yet, but it's something that we can and will look at for you.
Nice. Thanks, Nick. And I will say, just to go off of that, I know that there's a few clients of mine that we've already put into direct indexing that we've talked about and shared with them. And they are certainly seeing added complexity, but as we're already looking through it, as you know, even as the markets have gone up, there have, just to Nick's point, there have been opportunities to sell some of those holdings at a loss, and we're already starting to kind of build those up. And it's again adding that complexity, but for us, as Nick mentioned, it is not from a work perspective because of technology. It can still be just as easy for us and for our team to implement and carry out investment strategies that has direct indexing or utilizing ETFs.
Mm-hmm. Yeah.
Okay. So any other questions? I mean, if anybody wants to throw any more questions in there, we're here and happy to answer them. Nick, you can go to kind of the next step slide too, though, and because that might generate some questions too.
Yeah. So next steps after you digest all this information, I know it was a lot, so thank you all for hanging with us here. I'd say certainly one of the biggest things that we can do for you is do some really intricate tax year or end of year tax planning. And Bob has really great software again and tools to help us hone in on what exactly is the optimal thing to do, or it just helps us take into consideration all the different things in your life to make that decision easier for y'all. And then you can think about it. If decide, you don't have to decide right now or anything, but decide if the added line items and complexity of direct indexing is worth it to you. Maybe it is, or maybe it isn't. And if it's not, it's totally fine. Like, again, it's still beneficial for you to be investing the way that we've been doing it with ETFs. But now direct indexing just kind of supercharges that. So, and then lastly, next steps, I'd say, let us take a look. If you have taxable accounts held elsewhere, or you're managing them yourself, or whatever the case is, let us see and just be a second set of eyes on those and make sure that you're aware of the capital gain distributions from any mutual funds you hold, or if there's any capital gains or losses in those accounts that we should be aware of as we do this. So that way we're not investing or giving recommendations in a vacuum, right? Like, we want to know all the things going on in your life. So.
All right. Well, hey, Nick, I've got two more questions that came up, and I think they tie together pretty well. So I don't know if you see them on your side, but one is just asking to kind of walk through again comparison between an ETF and direct indexing. And then with that, with the numerous tax loss harvesting opportunities each month as it's related to direct indexing, how do we determine when to act on them? Is there certain criteria that says we need a certain amount of loss or certain sectors, or how is that kind of trade decision made?
Yeah, great question. So, first of all, yeah, I'm going to start with the second question first. So yes, there's criteria in place to determine when. Like, we don't want it to, you have a penny of losses or something and then trade on that. Typically, the thresholds that we use are a 10% loss threshold in stocks, and there's a lot of research that goes back to determine what is the optimal threshold to use. Is it 10%? Is it 15%? Is it 20%? And we found that 10% is kind of the most magic number there. Yeah, it's a big part of the process to make sure that we know what the thresholds are, and also tracking error, which is a whole separate conversation. But we want to make sure that the biggest stocks, especially in the US stock market, like Apple or Nvidia, that drive the most gains, just because there's a loss, or let's pretend that you invest in this and then there's a loss in Apple or Nvidia. We will book some of that loss, but maybe not all of it, because there's some stocks that have such big weighting in the index where it's really hard to replicate that even using other stocks or other funds. And so maybe we won't harvest the whole loss in the biggest positions in the stock market. So all of that is also taken into consideration as we looked at all of those numbers of those research studies that show what is the benefit of tax loss harvesting. All of those assumptions are actually in those research studies too. So, and then the second question was going back to
just to walking through again a comparison of an ETF and direct indexing.
Yeah, so an ETF, in this case, I'm going to use ticker symbol SPY, SPY. So we buy this fund, and inside the fund is 500 stocks. It's the US large cap index. But on your statement, if we just buy SPY, you only have the one line item that says SPY for this amount of dollars. Conversely, direct indexing is when we don't own that and we own these 500 stocks instead. And so you'll have
in the
500.
same weighting, correct?
Yeah, in the proper weighting, exactly. So if we had $10,000 just for round numbers of SPY, now we have $10,000 spread across these 500 stocks in the right market cap weighted positioning. So, yep. Okay. Hopefully that makes sense. The squiggly line chart's my best way to illustrate that. So,
Yep. Yeah, that certainly helps, and it can be confusing, or can be a lot to wrap our head around, especially at Balance. One of the things that, just as we've put the team and the vision together, one thing we've wanted to do is create simplicity, right? We don't want things to be complex just for the sake of being complex. And certainly when you're going from one ETF to 500 different individual stocks that some you may own in very small increments, it seems more complex. But this is one of those circumstances where, in our opinion, and in Nick's, kind of research that we've brought together, that the added complexity does add a true benefit. So that's where we're like, okay, if we feel that, yes, we want to simplify things, yes, we want things to be easier for our clients and for us across the board, but there's enough benefit here to go through with the less simplicity here, and then keep it simpler maybe in the IRA or the Roth IRA side, or whatever it may be. So, and I think that is an important consideration with all of this is, what are your other resources? What other assets do you have? How are we invested in your IRA relative to your brokerage account? We want to make sure all those balance, but do our best to be tax efficient where we can, and be smart about it.
mm-hmm. Yep. Absolutely.
Well, any other questions, or does anybody have anything else? We're at about 45 minutes, which is, right about where I was hoping we'd be, in that 45-minute to an hour range after questions and everything. So I appreciate everybody putting some questions in there. If there's more, feel free, we'll answer them here. But certainly want to wrap it up here this evening, just so we can let everybody off the hook and get to the rest of their evening. But first of all, I want to thank Nick. Nick, you did a great job. The presentation was great. Appreciate you walking everyone through this, and being here tonight. So thank you for that, for being a part of it. Send out the slides. Yes, we will absolutely send out the slides. That is one thing that we will do. One, this is recorded. we're going to find some points and kind of timestamp where some of the talking points are so that you can reference back to the presentation in the live setting, but also we'll send out the slides for everybody to review as well. If this is something that you are interested in, or you might know somebody that's interested in, just reach out to me, Nick, Tim, any of the team members here at Balance. We're happy to talk about it and go through it. And as I mentioned at the beginning, we're going to be doing a Roth conversions webinar here, probably in October is the goal. And if there's anything else that you all would like to hear about or have kind of a deeper conversation about, let us know. We would love to make sure that these webinars are helpful to you and not just us talking at you about things that we feel are important. We also want to make sure that they are things that you're wondering about, that you're thinking about, and we can help answer those questions for a lot of folks as opposed to just one-on-one. As much as I love the one-on-one, this helps kind of spread things out.
Yep.
So.
Absolutely. So I know y'all are going to be, just wired tonight, not able to sleep because you're so excited about taxes and direct indexing. But if you guys do have any follow-up questions after this, after you've had time to digest all this information, certainly feel free to reach out to myself or Bob. And I'm sure I'll see you guys in those end of year tax planning meetings too. So.
Okay. We had one final questions just about fees, and is this any more or less expensive as it relates to any of the investment accounts? And the quick answer is no, this does not add any additional fee to any accounts. No fees go up. There are no extra costs or charges that are associated with this. Depending on the custodian that you utilize, there may be different minimums. So we utilize both Schwab and Altruist here at Balance Wealth. So that may be a consideration, is just account minimums, but there are no fees, no trade costs for any of these strategies.
Yeah. Yeah.
Right.
Cool.
All right. Well, we'll wrap it up there. Nick, again, thank you so much for being on here and putting this together tonight. Thank everybody for being on here and being patient with us and being back after a week being off. But if you have any other questions or need anything else, please just reach out. But hope you all have a great rest of the evening.
Cool. Thanks.
Thanks, Nick. Thanks, Ryan.